once we're done with the statement cash flow from operating activities, we move to the cash flows from financing, from investing activities. The investing activities has to do with those items which we use to help us run the business, which are the assets or any trade investment. These assets or non-current assets we can either acquire or dispose. So if we've disposed, it means cash has gone out. Usually the disposal will be given in the question. Or you may have to work it out. You may be given the profit that you made when you disposed of an asset. Now remember, profit is not cash. How do you compute profit on disposal of an asset? It's disposal proceeds minus carrying amount of the asset equals disposal or loss. So if you are given the profit or loss on disposal, you have to work backwards to get the actual cash that you received when you disposed of the asset, or to compute the carrying amount of the asset which you've disposed. So that carrying amount of the asset you've disposed, you have to subtract it, remove it from your group of assets. Okay? And then the cash that you generated or you got from disposing of the asset is what will come in as a cash flow. Okay? The one which you are rarely given, and I'm yet to see a question where you're given this one, is the acquisition. The acquisition, you work it out as a balancing figure.
The cost?
No, the acquisition, the amount you spend to buy an asset. This one, almost 90% of the exams, you work it out as a balancing figure. How do you work it out? You start working with the opening balance. Okay, we have to do away with this board for now. Seems it's not working together with the recorder. I'll just talk you through. You have the opening balance, and then you leave space, you bring in your closing balance, which you close up. Okay? Then to the opening balance, you add any revaluation. Remember, revaluation is when an asset gains value. So you check any revaluations in the question, you add the revaluation to the opening balance. You subtract the depreciation, then you also subtract any assets which have been disposed of. Then you get your total. That total, you compare it with your closing balance. The difference will be the amount of assets that you've acquired in the period. You got that? You start with the opening balance. To the opening balance, you add any revaluation of assets which has taken place in the year. You take out the depreciation charge for the period. You take out any disposals of assets that has taken place Again, remember, you take out the carrying amount of the asset which has been disposed of. Then you sum total. Your total, you compare it with the closing balance, again, which will be given in the balance sheet in the question. The difference between the two will be the cash which has been paid out to acquire new assets. So you bring that as an outflow. Then if there are any other assets which have been acquired or disposed of, depending on the question, any trade investments, you bring those ones in. Also, if you've made investments elsewhere and you receive dividends or interest, that will also come under what? Investing activities. For example, maybe you're an associate. In the associate, they pay you dividends. You're the subsidiary, they pay you dividends. Or you had any investment which generates you some income of some sort. That will come under this section as cash or cash generated from investment. Then you're going to sum total and close and transfer your figure to the last column, so that it joins the total of the cash flow from operating activities. Then we go to the last items, which is cash flow from financing activities. The financing activities are those activities how we finance the business. If we finance the business through new shares, new issue of shares, if we finance the business through borrowing. Now, in either situation, two things could happen. You could raise more funds by issuing more shares. Okay? With the debt, you could raise more funds by borrowing. If you've borrowed more funds, then cash has come in. But you could also pay back the loans. So you look at the movement. As the loans increased, or as the loan reduced. If the loan has increased, then you've borrowed, cash has come in. If the loan has reduced, the balances from last year to this year, it means you've paid out, cash has gone out. Also, in this section, if you've paid dividends to shareholders, that will also come under this section. You subtract the dividends that you've paid. Also, if you've got any finance leases, any finance lease liability payments that you've made will also come under this section. Once you are done with this section, you close and transfer the balances to the last column. So in the last column now, you're going to have three totals. One total from cash flow from operating activities, the other total from investing activities, and the other total from financing activities. You then add these three totals. When you've added these three totals to the figure you have, you go to the statement of financial position and pick the cash opening balance. You add it to these three totals. Okay? Now, the cash balance, if there was cash in the bank, you're going to add. But if you find that under the current assets there's no cash balance, you go to the liabilities and check for the overdraft. then the overdraft you're going to subtract. Okay? So the figure you're going to get by adding or subtracting the bank balance to the total of your three operating, investing, and financing activities should be equal to the bank balance, closing balance in the statement of financial position this year. So the last two entries that you bring will be the opening cash balance and the closing cash balance. Basically, if everything has been done correct, when you add or subtract the cash balance, your final figure should be equal to what is in the bank. Whether it's an overdraft or there's cash in the bank. Then you know that you've done the correct thing. You also need to know the ratios which are involved in the cash flow statements. Okay, you can take down these ones. I'll quickly give them to you. The first one is cash return on capital employed. Cash return on capital employed, which is given as cash generated from operations, divided by total assets less current liabilities. Total assets less current liabilities times 100%. The second is cash generated from operations to total debt. Cash generated from operations to total debt equals cash generated from operations over total debt.
Cash generated from operations over total debt.
Correct, yes. The third one, net cash from operating activities to capital expenditure. Net cash from operating activities to capital expenditure. Net cash from operating activities over net capital expenditure times 100%.
Cash from operating activities
over net capital expenditure times 100%. So that concludes the statement of cash flow. So let's look at some questions